all of our risk models were powered primarily by quantitative signals. So we're looking at volume, price action, liquidity, depth, all these things across different markets. But oftentimes the vast majority of the time, the driver to all of this type of price action and volatility in the market is news itself. And when news breaks, now we can react to it much faster.
Alrighty, what is going on, everybody? Welcome back to another fundamental video breakdown. We're going to do a brief update on where we're at in the market landscape. We're going to take a look back at some predictions and some analysis that we were giving you guys, showing you all that in this community, myself and Scalper are always in an attempt to keep you guys in the loop with what's actually happening in the market, not give you guys hype, speculation, and unrealistic expectations in these markets. I myself was recently warning you guys of the possibility of a market pullback. You can see in the total cryptocurrency market cap that is reflected in today's price. We are seeing one of those down days where the market is down over $178 billion as of time of recording. We had XRP touch our institutional sell delta area, which we'll get into in just a second. So I'm just going to continue to go over these fundamentals with you guys and show you all why it's so important that you understand them. If you're new to this community, hopefully you guys have been catching on, reading the reports that I deliver for you all thoroughly, and then also rewatching any missed Zoom calls or tapping into these Zoom calls with us so that way you can actually stay in the loop with what's happening in the markets. We separate ourselves from other communities. As you guys can see, the market cap reached a new high of $4.189 trillion, and everybody got euphoric and started to think that the market was going to continue to rally higher. We set ourselves realistic expectations, and we were talking about the opposite of that possibility happening and unfolding, and that is higher inflation, upbeat labor market data, hawkish Fed rhetoric, possibly pushing back on the recent rate cut euphoria that we've seen priced into the markets. And that's the exact environment that we got today in risk assets. Now, this does not mean that we're going to enter into some bear market cycle or anything of that nature. We just have to understand that we are in a headline-driven environment, and these algorithms and these institutions, they adjust based off of that intraday sentiment. And so today, that sentiment is showing a risk-off form. That could change in the coming days, but again, we need to see the data and the rhetoric support a continued risk on environment to see prices recover from where we're currently sitting at today, which is possible. But again, we're going to continue to remain tentative to upcoming data releases, especially with the consumer sentiment, the retail sales, and the inflation expectations tomorrow. We also have Trump and Putin meeting in Alaska tomorrow as well to be mindful of. Any geopolitical tensions and rhetoric surrounding tariffs over the weekend. And then heading into next week, we have the Jacksonville Symposium where Jerome Powell set to speak, which in my personal opinion is going to be of key focus. If we want to see any form of major market recovery, we're really going to be paying attention to what Jerome Powell says, considering that now he has some labor market data and inflation to go off of in his rhetoric next week. So very tentative, but let's just take a look back at what myself and Scalper this past week have been delivering you guys in the Discord. So to show you guys, and we're just going to fixate our attention on XRP for the sake of this video breakdown. And then after this, I actually want to go over some recent things that have happened in DeFi protocols on the XRPL. Why we try to tell you guys to not just bum rush these protocols and test them out with test amounts, or we test them out ourselves and show you guys those test amounts. And why that's so important via some recent events that unfolded on a protocol that was built out on the XRPL. So we'll get into that as well. But let's go back just to show you guys the technical analysis aspect of this community. If we go back to, I believe it was August 8th. Yep, right here, August 8th, 2025 at 9:01 a.m. This was at the beginning of the week when I had done my analysis and updated my deltas. You can see that Scalper had given us some buy deltas of $2.96, $2.75, and $2.56, with a sell delta that came in at $3.59, with this other sell delta at around $3.44. And in this fundamental breakdown from August 12th, let me slide my computer over so you guys can hear this. In this fundamental breakdown from August 12th, timestamps are extremely important to us here in this community. I had been telling you guys that if the market sentiment soured, if we saw if we saw stronger labor market data and we saw firmer inflationary figures pushing back on the odds of rate cuts, then the likely scenario was our first bearish target was to be met on XRP. And I had reiterated to you guys on August 12th, days in advance, that that target was $2.96. Take a second here and listen. If sent for XRP, 296 is still our immediate downside target if sentiment sours and we cannot break above these most recent highs. Anything below 290. And so just taking a look at XRP's price action right now, days later, right? No extensive or outrageous targets, no unrealistic predictions, no freaking, retail trading technical analysis, no, I don't know, indicators, all that crap that retail traders use, just strictly fundamentals and institutional deltas. You can see the accuracy of that today during the market sell-off. XRP failed to break above that high that we had annotated days before, where we could see clear as day there has been sellers defending this price for quite some time, since pretty much the beginning or middle of July. Sellers yet again defended their positions, trapped buyers at these highs, sold off into the $2.96 level to almost the T of a degree, right? So anybody that has been tracking these fundamentals instead of paying attention to the retail hype on the internet, where people have been saying that I don't even know, XRP is going to go to freaking $10 by the end of August, whatever crap floods the internet now. You guys can see, painting a realistic perspective for you all in this community. Hopefully, it saved you from buying into the hype, buying at tops, and now you guys can decide whether or not to situate yourself at a discount to mitigate your downside exposure in these markets, right? Maximize your upside return, which is the goal, hopefully, of any investor. On the fundamental side of things, if we go back to our August 12th fundamental breakdown on that same day, I had warned you guys of a possible pullback. As I finish off this report down here at the bottom, I said to you all, the bullish momentum in risk assets depends on continued data that supports rate cut odds and keeps the dollar weaker. Any geopolitical outbursts, negative tariff headlines, upside surprise in inflation, labor strength, stronger U.S. retail sales, or hawkish central bank rhetoric could quickly reverse the current sentiment. This is a week for discipline over euphoria. Then the following day, in our August 13th report, when we broke down the CPI data and we did a forward outlook on the PPI data that we were set to get today, I gave you guys some scenarios here. One that would be bullish for risk assets and one that would be choppy. And the third scenario being a pushback or what would be bearish for risk assets. And you can see scenario number 3 in yesterday's report came out today. So that scenario was a pushback on rate cut bets, which would be intraday bearish for risk assets. PPI and core PPI surprising to the upside, suggesting sticky producer prices. Jobless claims coming in much lower than the market had forecasted, showing labor market resilience. The market reaction would likely be traders scaling back rate cut expectations, pushing yields higher, strengthening the dollar, and prompting a correction in risk assets. And that is exactly what we got. All right. Then down here at the bottom to end this report, I mentioned to you guys, at time of writing, the total cryptocurrency market was hovering around the weekly high of about 4.1 trillion. This momentum can continue if fundamentals remain supportive, but I mentioned here, traders should remain reactive and ready to adjust if inflation or labor data pushes back on rate cut prospects, or we get any hawkish Fed comments that dampen rate cut hopes. Yesterday, as we rolled into Asia session, I shared some of those hawkish comments for you guys in the fundamental section where we got some more hawkish leaning comments from Fed Bostic. You can see here. Fed Bostic mentioned that a stronger labor market data gives the Fed more room to wait on the next policy move. That is a hawkish comment, and that started to weigh on market sentiment during Asia session yesterday as we started to see some profit taking unfold. Now, fast forward to where we're at today. All right. You can see retail articles catching up to us here at CYPRX. This is very common in this community. You can see that this article is from today, the 14th of August, and it talks about Ripple and XRP's price. But down here at the bottom, it says, investors in risk assets, including crypto, are on edge, concerned about the impact of higher prices of goods and services, which could drive inflation and further delay the potential Federal Reserve rate cuts, largely expected to begin in September. So imagine how many uninformed retail investors are out there trying to figure out why the market sold off, why their portfolio was down today, especially if they recently bought into the euphoria that the market has seen. You don't want to be one of those types of investors. You want to be one of the types of investors who was saving capital during the euphoric rally that we've recently seen to then go out and deploy during times of market downturns like this. I'm not telling you guys to go out there and deploy today, but the market criteria has been met for us to possibly look at some dollar cost average positions for our long-term portfolios. That's one. The total cryptocurrency market cap sheds over $100 billion. Two, we see risk off intraday fundamentals. And three, the crypto fear and greed index drops below the 50 grade threshold. Now, I haven't checked the crypto fear and greed index. I'll save the time for that today in the video breakdown. But still, regardless, now's the time, if you're choosing to dollar cost average into these markets, where you would want to be doing so to mitigate your downside exposure and maximize that upside return. All right. So hopefully we've been keeping you guys in the loop in this community as to what has been going on. So let's break down the inflation report today so that way you guys understand the landscape, talk about what could possibly happen tomorrow given the fundamental data, heading into the weekend as well. And then I already mentioned what we're going to be mindful of next week. So today, the July 2025 US PPI report came in much hotter than the market had expected, with broad-based gains in producer prices signaling sticky and accelerating inflationary pressures. At the same exact time, jobless claims data showed improvement, pointing to a still firm labor market. So, had you guys have read our report from the day before, this is why we talk about these things. Again, like I said, the scenario number 3 was hit on the head. We saw equities and futures markets sell off. We saw crypto sell off as soon as the data came out. This was likely the start of the pushback on the odds of aggressive Fed rate cuts in the near term and leads towards a higher for longer rate narrative, like Fed Bostic had mentioned in his report yesterday. So to go over the inflation details, the PPI month over month came out at 0.9%, which was a huge beat versus the 0.2% expected from a prior reading of 0%. The core PPI month over month came out at 0.9%, a huge beat again from the previous readings. The PPI example in the food, energy and trade month over month came out at 0.6, which was way above the normal and above the prior reading of 0%. The year over year changes, we had the core PPI year over year come out at 3.7%, which was a big jump from the previous reading of 2.9%. Excuse me, the 2.6%, which was the prior reading versus the expected, which was 2.9%. And then we also had the PPI year over year came out at 3.3%, which again was sharply up from 2.4% and the 2.5% expectation. So this is a broad upside surprise across headline, core, and trend PPI measures. It's not just volatile components. Underlying producer prices pressures are accelerating as well. This suggests inflation could filter through to consumer prices in coming months, making it harder for the Fed to justify cutting rates soon. If you guys remember, I believe it was on August 1st. It was the first week of August. We hosted a Zoom call, and I gave you guys a forward outlook all the way up until the September 17th meeting, the next FOMC meeting, what type of data we wanted to see to support the odds of continued rate cuts and continue to see that risk on momentum up into that meeting. And so far, we're not seeing that, right? We're seeing that the market might be getting ahead of itself. And if that is to be the case, the data continues to come out, pushing back on those rate cuts, then odds are we're going to continue to see the market price out those aggressive rate cut bets, and we're going to continue to see a risk off induced correction. Now, I'm not saying that that's guaranteed, but again, we just need to continue to adjust as the data and the reports come out intraday, week by week. The initial jobless claims as well came out better than expected at 224,000. The expectation was 228,000, and the previous reading was 227,000. So it came out 4,000 jobs lower than what the market had expected. Continuing claims came out at 1.95, which again was better than expected at 1.96, and the revised figure at 1.96 as well. The labor market still remains resilient with no signs of the kind of weakness that the Fed would want to see before easing policy. Lower claims mean fewer layoffs and sustained hiring demand. So before the data, the markets were pricing in a 90% plus probability of a rate cut in September based on the softer CPI forecast and cooling labor market narrative. After the data, the hotter PPI and stronger jobs picture undermines that expectation. Now, I don't think it completely changed the narrative, right? One higher inflationary report does not completely dampen the odds of rate cuts in September, but we need to continue to be mindful of the data moving forward. That means every single week moving forward up into the FOMC meeting, if we continue to see hotter jobs data, higher inflation, and hawkish Fed rhetoric, then the likelihood of the Fed cutting rates in September is going to continue to weaken. All right. So just be mindful of that. So that's it for the PPI and the unemployment figures today. Let's just take a look at tomorrow's data real fast. Keeping in mind as well that we're going to have some headline reactive news surrounding the Trump and Putin meeting that's set to take place in Alaska tomorrow. So we will be mindful of that. Obviously, of course, any ceasefire announcements or positive rhetoric surrounding the Russia-Ukraine conflict possibly coming to an end will likely support risk on sentiment, right? And we could see some type of intraday recovery from today's sell-off. All right. You can see here, even in the rhetoric today, it says Trump on the Putin meeting. Trump said that he thinks that they're going to be able to make a deal. So if some type of positive deal that, positively affects all jurisdictions involved in this whole entire debacle is announced, it could positively affect risk assets and create some type of intraday risk on mood, or at least stop the sell pressure that we've seen today. All right, heading into the weekend. But tomorrow for our scheduled events, we do have rolling over into Asia session the GDP figures from the Japanese front, which we do need to be mindful of. Any stronger figures or upbeat data could drive strength of the yen, which we know inherently can weigh on risk assets. And then tomorrow we have the core retail sales, Empire State Manufacturing Index, consumer sentiment, and inflation expectations. So ideally across the board, we would like to see data that supports the odds of rate cuts in September. Inversely, to keep it in a nutshell, short and sweet, any data that supports the strength of the dollar or pushes back on rate cut bets is likely to continue to weigh on risk assets. All right. So just be mindful of that. Personally, I stopped trading Fridays. I know that Justin's laughing at me when I say that, but I personally don't. And tomorrow is my daughter's birthday, so I will not be mindful of the data tomorrow. Probably going to take a day off. All right. Outside of that, heading into the weekend, we still need to be mindful of any geopolitical headwinds. We did have a slight uptick in headwind sentiment surrounding the Middle East tensions. There was an announcement from Europe. Um, I don't remember off the top of my head what it is. I know I shared it in the fundamental section, but there was a threat on the Middle East from Europe to initiate sanctions again if they did not commence to another extension in the ceasefire deal between Israel and Iran. Um, and I haven't seen any new headlines on that topic. However, just still be mindful that any negative sentiment surrounding the Middle East, Russia, Ukraine over the weekend, or Taiwan and China could obviously, of course, sour sentiment and create more demand for safe haven assets. Outside of that, I think for now, heading into next week, we're probably going to be light on the tariff announcement front, but we still need to be mindful of any tariff related announcements that could cause uncertainty in the markets between China, the US and Japan, or any other major jurisdictions like the EU and the US, Mexico, Canada, so on and so forth as we head into the weekend, which again could still come on the limelight. All right. Inversely, if anything comes out positive in terms of net announcements, supporting risk on sentiment, that could obviously, of course, rekindle the losses from today. But again, I'm not expecting any tariff announcements in the near term this weekend. Still possible though. Heading into next week, all right, let's just take a real quick look since we're not going to host a Zoom call tomorrow. Next week, we have the FOMC meeting in minutes, which is going to give us some insights into the Fed's perspective on economic policy or the economy, the strength of the economy, up and coming monetary policy. It's just going to give us a deeper perspective from the FOMC meeting and what the Fed was thinking at the time. So that's going to be very mindful on our headline tentative news. Thursday, we have unemployment claims, Philly Fed manufacturing index, and flash PMI figures. So pretty much next week, it's going to be relatively dry up until about Wednesday. So Sunday, Monday, Tuesday, probably going to be low volume and volatility days, unless some of the Fed speakers that we have scheduled say anything outrageous or crazy, or we have any headline news events surrounding geopolitical tensions or tariffs. But up until next week, Wednesday, we don't have any scheduled data. Thursday is when we're going to get the unemployment claims. That's going to be important, and we have more Fed speakers to be mindful of. That is also when we're going to get those PMI figures. And then Thursday is also when the Jackson Hole Symposium starts to commence. All right. Friday is when Jerome Powell is going to be speaking. So that is going to be our key focus. I wouldn't be surprised if the market just does some choppy ass consolidation structure next week up until Jerome Powell speaks at the Jackson Hole Symposium. Outside of that, in terms of fundamentals, that's really all I have for you guys today. This week was a prime example of why not to get euphoric and instead wait for the data, which I saw a lot of you guys do. Hopefully, you all in your portfolios are benefiting from that today, where now you can go in and you can get some good blue chip digital assets at a discount instead of buying into the rally. So continue to pay attention. We'll continue to ignite, enlighten you guys on these fundamentals next week. Make sure that you guys update your deltas if need be. Make sure that you guys are setting alerts and alarms if you're going to be dollar cost averagers or looking for trades. And then for anybody that's in DeFi related positions, make sure that if you're in drawdown or your positions are out of ranges, you don't react based off of the current market sentiment and you give your position some time to breathe in case the market recovers, right? So Kev talks about this 48-hour waiting period where if your position comes out of range, give it some time before you consider adjusting just in case it does go back in range and the market recovers heading into this weekend. All right. Outside of that, in terms of fundamentals, that's all I have for you guys today. I'll take a brief pause right there. And if anybody has questions surrounding the fundamental backdrop and what we covered this week, go ahead and ask now. Okay, cool. So now let's roll over into XRP DeFi. So as you guys know in the Wealth 28 Club and in this community, we have been really headstrong about how we're going to earn yield on our XRP, ways to go about doing that. But we've also been very cautious on deploying onto these protocols with our XRP to earn yield. I've been an advocate of trying to tell you guys that I'm personally not deploying any of my XRP on any of these platforms outside of small test amounts for reasons that I'm going to show you guys today. So I would like to see TVL significantly surpass $1 million on these platforms in vaults or in liquidity pools that XRP is involved in before I deploy. I would like to see longevity on these platforms' behalf. So I would like to see after launch them not have any negative reviews or any negative sentiment gifted towards them within a 6 month to a year long period. I would like to see them work out kinks and bugs that they might have, which again, we're going to currently go over today. And transparency is key. And so there's also platforms that aren't really being transparent and their docs kind of contradict what they say on their website, which I haven't gotten responses back for yet since I've called them out on it. And so most of the protocols that are being deployed or built out on the XRP out now today, I still wouldn't deploy my XRP on these platforms. I'm still waiting very patiently to see how Firelight comes out when they launch on Flare Network officially on the mainnet. That is yet to come into fruition. They continue to say that they're working out things and that that is going to launch very soon. Who knows when that's going to be? I'm continuing to monitor those updates. But as of time of recording today, our primary focus has been on Strobe, it's been on Elise Network, and it's been on more markets. And each of these platforms I'm still not deploying on, even though they offer some good yielding opportunities and lending and borrowing. I still wouldn't touch them with the 10-foot pole, in my personal opinion. That's just me. Nothing against these platforms, and I'm not talking shit. I'm just attempting to keep my wealth long term and not have it exposed or exploited. So, with that in mind, recently our security measures and what we look for before we aggressively launch on these platforms has worked because Strobe Finance recently experienced a temporary pause. So, check this out. This is from Strobe Finance, where it says a security update, a temporary pause of the Strobe protocol. We recently identified a vulnerability in our liquidation process. However, thanks to our ongoing stringent security monitoring, this was discovered before it could be exploited, which is great. Kudos to them. This is phenomenal to see, but this is exactly why when these platforms launch, we give them at least a 6 month period. At least I do. I can't control what you guys do before I aggressively deploy capital on these platforms. And if I do deploy capital, it's just small test amounts to get used to the user interface. So they said here, we would like to clarify, no exploitation was detected. We have confirmed that there is no evidence that this vulnerability has been attempted. Full protocol pause as precaution. We have temporarily paused all protocol operations while we deploy the mitigation patch. Proactive detection. This was identified via our own security measure and not through any external exploitation. Our layered security approach has ensured your funds remain secure. The pause is purely preventative and will remain in place until the team's confident that the vulnerability has been addressed. So it's great to see that they're reacting to these things in a fast, efficient, and safe manner. But still, this is just a prime example of why, when these protocols launch, whether it be lending and borrowing, vaulting, yield farming, liquidity pooling, that you don't just go out, bombard them with massive amounts of capital and expose yourself to unnecessary risk. Fast forward, they gave an update where they said lending and borrowing and withdrawals has been resumed. Strobe is back online earlier today. Their team, working with an external security partner, identified and fixed a vulnerability. So it's great to see that they fixed it. Funds remained secure throughout, and we acted before any risk could materialize. As a precaution, we temporarily paused lending, borrowing, and withdrawals while we investigated. Applied the fix and confirmed stability. That work is now complete, and there is no action needed by users. Now, the reason why I'm reading this to you guys, the one thing that I don't like about this is where they said withdrawals were paused, right? So that means that this platform does have full control of your assets. And if something were to happen on their back end, or, you know, whoever it is that controls this platform, again, nothing against Strobe Finance. I'm super excited to have them on a podcast August 22nd, but this is something that you need to consider, right? If you're going to utilize this platform for lending and borrowing, if something were to go south, they do have the ability to completely pause withdrawals, right? That's one of the reasons why I was staying away from this platform here, more markets, because when I had messaged the co-founder, I don't know if it was the CEO or the co-founder of this organization, and asked them the question where in their docs they kind of contradict each other. It says here, just for example, I'll show you guys. It mentions never worry about finding the best yield, real-time yield, secure strategy optimization, and that you stay in control of your assets. Down here, they also mention the same thing. Are there hidden fees or withdrawal restrictions? There are no hidden fees. More markets show all fees up front. You can withdraw your funds at any time, subject to market liquidity conditions. And then in their documents, excuse me, it mentions over here as well, while still keeping their ownership of their assets and on their home chain. With more markets, asset holders who are bound to their economic zones can participate in ecosystems that are not native to their assets and that they control their assets. But then when you come to deposits and withdrawals, it says right here. When a positional token holder wants to withdraw their funds from the more markets, they need to put their positional token in the principal chain's vault. The withdrawal requests goes into a global queue that is publicly available for anyone to see. The protocol first looks internally to available capital that is not allocated in the vaults to solve the withdrawal requests. If there is enough capital, the protocol triggers an in-protocol withdrawal flow. If there is not enough capital in protocol vaults or all positions are allocated, any solver who wants to fulfill the withdrawal request can offer what the withdrawal wants and fulfill the withdrawal request. If there is no solver until time of expiry, withdrawal requests get canceled. So I didn't like that because it just goes to show that your withdrawal requests can get canceled even though the website claims that you have full control over your assets. That to me, again, just, I don't know, just screams red flag. I don't want to not have control over my assets or be able to withdraw at any point in time that I want. So yet again, another just risk that you have to consider if you're going to, expose your XRP or any crypto to yield. This platform as well, we had a really great conversation, myself and Aqua, with the co-founder of the Elise Network. I don't remember if he was the co-founder or the CEO of this organ. I think he was the CEO. But you can see here that they had a substantial drop in TVL in their XRP vaults. And so I remember briefly talking to the gentleman, and he mentioned that in order for people to continue to allocate into these vaults, they need to see a substantial increase in the TVL. That is yet to take place, and the TVL to me still just looks sketchy, something that I personally right now don't want to be a part of until that increases substantially. So again, just putting all these protocols on ice, being patient and taking advantage of other more mature DeFi ecosystems, I'm personally fine with. You guys, again, I can't control what you do with your assets or what you do with your portfolio, but I suggest not using these protocols until they mature, they show more longevity and security on their behalf, and things just kind of again develop a little bit better than what they're currently seeing or what we're currently seeing now. All right. So I just wanted to give you guys a quick update on that because somebody had DM'd me and asked what I'm doing with my XRP. Personally, right now, I'm not really doing anything with my XRP, my long-term bags. I'm very okay with just accumulating more XRP that I plan to use for DeFi at discount positions like we just recently saw today. I put like another $300 into XRP at roughly about $2.97 that I'll just keep in my cold storage waiting to deploy in the DeFi ecosystem when the timing is right. I'm in no rush. All right. So whoever answer or asked that question, hopefully you're on the Zoom call today and that question has now been answered.